Welcome back to the Deep Dive. Today, we are analyzing a company sitting right in that digital sweet spot, Zaggle Prepaid Ocean Services Ltd.
Yeah, this is a fascinating one.
You, our listener, sent us a stack of sources that paint a picture of truly explosive growth. We're talking headline numbers that are, well, frankly, off the charts.
But there are also some deep financial tensions here that the market seems to be really grappling with.
Exactly. So our mission is to move past the headlines. We're going to quickly decode this company's financials, understand its growth trajectory, and really isolate the key risks from these documents.
A shortcut to being well-informed. I like it.
So to start, you have to understand the company's identity, right? Where do they fit in?
You do. And Zaggle sits squarely at the intersection of SaaS, that's software as a service, and Fintech.
And that's more than just buzzwords.
Oh, absolutely. It means their core business is providing proprietary tech solutions for world-class financial products. Think of it this way. They are building the rails, not just running the trains.
Okay, so what specific problem are they solving with these rails?
They're a B2B2C fintech SaaS company, so they specialize in spend management.
Spend management.
Right. They automate and innovate the workflows for business expenses. Whether you're a huge corporate or a fast-growing startup, they offer solutions like automated tax and pay platforms.
So they help companies manage their money smarter.
That's the gist of it. It's a huge growing market, as you can imagine. Every business needs to digitize its financial controls.
Which brings us to the big question for today. Have they scaled effectively? And more importantly, is that scaling financially sound?
That is the question.
Okay, let's jump right into segment one, because these historical growth figures are just stunning. Over the last 5 years, the compounded sales growth, or CAGR, has been 80%.
80%, that's already incredible.
But here is the real jaw-dropper. Compounded profit growth over that same 5-year period is an eye-popping 88.0%.
Wow, okay, those numbers, they signify massive operational leverage kicking in. That is exactly what you hope to see from a SaaS model that's in hypergrowth.
And they're not a small player.
Not at all. They have a substantial market cap, around 5,104 crore. And, in terms of stability, the sources confirm a huge positive. The company has drastically reduced its debt.
So they're almost debt-free.
Classified as almost debt-free, yes.
Okay, let's unpack this phenomenal scaling against the market's reaction, because here's where it gets really interesting.
The disconnect.
The huge disconnect. How can a company post an 88% profit, CAGR, get rid of its debt, and yet the stock price CAGR over the last year is negative 20%?
The market is actively punishing it, or at least it's very skeptical of that growth.
It seems so. And the stock trades with a high PE of 45.8.
Right, which signals investors are pricing in huge future growth, maybe even impossible expectations. But that 20% stock drop suggests the market is deeply worried about the quality or the cost of that growth.
So where does that worry come from?
Well, when you look at the efficiency ratios, the market's skepticism starts to make sense. The return on capital employed, ROCE, is currently 13.0%.
13.
And return on equity, ROE, was 9.60% last year. If you average it out over 3 years, the ROE is stubbornly low at 12.4%.
Those are not the numbers you'd expect from a company reporting 88% profit growth.
Not at all. And the source documents list this as a con. This low 3-year ROE and the fact that despite all these profits, they have a 0% dividend payout.
They're hoarding capital.
They are. It suggests they either need it desperately for more investment, or they just aren't generating enough high-quality, distributable cash. It forces us to ask, is this 88% profit number an anomaly, or is there a massive investment story hiding just beneath the surface?
That sets us up perfectly for segment 2. Let's dive deep into those detailed financials, starting with the annual profit and loss.
Good place to start.
The leap in total income is just undeniable. It went from about 553 crore in March 2023 to over 1,300 crore in March 2025. The trailing 12 months figure is now at 510 crore.
The sales momentum is robust, no doubt. TTM sales growth is at 47%. But we need to check if those profits are sticky.
And the margins.
The operating profit margin, or OPM, was historically pretty volatile. It went from 16% in 2020 down to 9% in 2023. But critically, it has settled and stabilized right around that 9% mark for the last 2 full years.
So they're keeping costs under control even as they scale up revenue.
It suggests that, yes, management seems to have a steady hand on the core cost structure.
But the quarterly results, as we know, can tell a different story. And looking at the profit before tax quarterly, I see some serious fluctuations.
Mm.
PBT was only 3 crore in June 2023, but then it rocketed to a peak of 44 crore in September 2025.
That fluctuation in absolute profit, even while the quarterly OPM stays consistently tight in that 9 to 10% range, it suggests the top line isn't entirely stable.
What do you mean?
It raises the question, are these profits based on steady, predictable subscriptions? Or are they from large, lumpy contract wins that hit the books unevenly?
Right, so the margins are stable, but the revenue might not be, and the market seems worried about the return on those costs.
Which brings us back to those efficiency metrics. This is where the puzzle gets really complicated.
Okay, let's go there.
What's fascinating is the sheer velocity of the decline in ROCE. The return on capital employed was an astonishing 154% in 2020.
154%.
154, almost unheard of.
Yeah.
By 2024, it had fallen all the way down to 13%.
Wait, that sounds completely counterintuitive. How can profits grow at 88% while the efficiency of the capital generating those profits plummets from 154% to 13%?
This is the absolute crux of the entire story. The 154% ROCE in 2020 likely came from running a highly capital-light model, maybe a distribution or reselling business that required very little internal infrastructure.
Like a successful tailor shop. Small capital base, big returns on each sale.
Exactly like a tailor shop. But the drop to 13% signals a massive, deliberate strategic shift. They stopped being the tailor shop and they bought a full-fledged proprietary factory.
Wow.
The company moved to a full-stack, infrastructure-heavy platform model, and that requires huge investments in tech, servers, intellectual property. The absolute profits are bigger, yes, but the capital base, the factory, has grown so much faster that the ratio, the ROCE, looks terrible for now.
So we should be looking at this decline not as a failure, but as a necessary, if very expensive, strategic decision.
Precisely. And we see more evidence of this in the cash conversion cycle.
The CCC.
Right. It tells you how long it takes to turn an investment back into cash. It has remained consistently high 82 days in 2024, 60 days in 2025. A high CCC ties up capital, confirming that this company is actively sinking money into its operations.
That makes the whole narrative much clearer. They've transitioned models. So let's look at segment 3 for direct evidence of this investment. What are the growth drivers?
Well, we have concrete evidence they're executing on this new, expensive strategy. A recent announcement, dated November 20th, 2025, shows Zaggle secured a big multi-year contract with Biba Fashion. They're providing their Zoyer platform for 36 months. That's a huge strategic win, showing they can land major enterprise clients with this new infrastructure.
And that success is getting noticed. On the very same day, it was announced that Zaggle was selected among the top 10 of DGMS 2025 by Forbes India.
So this isn't just internal hype. They're being recognized as a high-potential digital company capable of scaling.
Which brings us to how they paid for all this, the capital.
Exactly. The sources confirm this huge strategic investment required massive financing. We know from a monitoring agency report that the company did 2 huge raises. IPO proceeds of 392 crore and QIP proceeds of nearly 595 crore.
Just to clarify for our listener,
Sure.
a QIP, that's essentially a fast-track way for a company to raise capital directly from big institutional investors, right?
That's a great way to put it. It's sophisticated, fast financing for aggressive expansion. And the report confirms that these massive funds, nearly 1,000 crore, are largely utilized.
So money is being spent.
It is. Now, connect that back to the balance sheet. Total assets jumped from 235 crore in 2023 to a huge 1,373 crore by September 2025.
Wow.
This is the smoking gun. It links the capital they raised to the dramatic fall in ROCE. The company didn't just become inefficient. It raised money aggressively and deployed it instantly to build the foundation for those future contracts.
That is such a critical distinction. Okay, let's synthesize this in our final segment. This whole narrative is about risk tolerance and future payoff. What does this all mean for someone tracking this?
It means you are looking at a high-stakes, high-growth gamble. On one hand, you have explosive revenue and profit growth, zero debt, and proof they're securing major clients.
They've successfully raised and deployed the capital.
They have. But on the other hand, the market clearly sees the risk. So what are the key areas for you to watch moving forward?
The red flags.
Right. First is the financial efficiency risk. The vast influx of capital has not yet generated proportionate returns. That's clear from the low ROE of 12.4% and the collapsed ROCE. The market needs proof the factory they built will soon run at full capacity.
Okay, risk number 1.
Second, the valuation risk is acute. That high PE of 45.8 means the company has no room for error, and that negative 20% stock drop shows investors are already nervous about the timeline. They're waiting for those efficiency metrics to catch up.
And we should briefly mention the shareholding pattern, which often reflects this anxiety. The promoters are steady, but we see a lot of fluctuation among FIIs, the foreign institutional investors.
They're actively adjusting their positions based on the risk, which is exactly what you'd expect.
So the ultimate takeaway for you, the listener, is this. Zaggle is a high-growth company in a crucial sector making a very aggressive strategic shift. The financial picture demands careful tracking of how all this new capital translates into actual capital efficiency.
Exactly. A rebound in ROE and ROC, that is the ultimate gauge of success for the next 18 to 24 months.
Don't just look at the profit number.
Do not. The strategy is clear. Use the funds to expand and lock in large long-term contracts. They have done the hard part, building the foundation.
This has been a fascinating deep dive into a company right in the middle of a huge transformation. Thank you for sending in these sources and fueling our curiosity.
My pleasure. And as you track Zaggle's future results, you should focus less on the absolute profit number, which we know has been fueled by that massive 88% profit CAGR, and more on whether the 3-year average return on equity, which currently sits at a mere 12.4%, begins to rebound. That efficiency metric will be the clearest sign that all those major capital investments are finally paying off.